This in the studio. Hi there, Marcus.
Hi there, Laura.
First up, some good news at last. The IMF is painting a rosier picture of the global economy.
Yeah, the International Monetary Fund came out with its latest health check of the global economy a little bit earlier. It actually shaved 0.1% off a previous growth forecast for this year. It now predicts a growth rate of 3.6% this year, which is still seen as a pretty strong figure if you compare it to 2013, for instance. And it also expects, the IMF that is, also expects growth to accelerate in 2015. The fund says that the global recovery is stronger and broader than it was just 6 months ago. If we break down the headline figure, the IMF says that the US economy is fueling global growth with an expected expansion of 2.8% this year. Japan and the Eurozone are behind, but their rates are getting better. Look at the Eurozone there, up 1.2%. That's the kind of growth rate we're expecting in the 18 countries that use the single currency this year. At the same time, however, the IMF cut its forecast for emerging economies. And emerging economies, they include countries like China and India, for instance. Now, the IMF also slashed its growth forecast for Russia to 1.3% from 1.9%. The IMF says that Russia is already dealing with economic headwinds, and geopolitical tensions with the West over the Ukraine crisis could make the situation even worse for Russia. IMF chief economist Olivier Blanchard explained how Russia could feel the pinch.
The first one is an investment climate, which was not perfect to start with and is probably a bit worse, and more hesitation on the part of investors to either put their money in Russia or leave it in Russia, so that one can expect fairly substantial capital outflows.
Now, the IMF also called on the European Central Bank to do more to stimulate the Eurozone economy. That coincides with a similar message from France's new Prime Minister as he spoke to the French Parliament for the first time since his appointment. Manuel Valls warned that French efforts to make it cheaper to do business would be in vain if the euro remains as strong as it currently is. Delano de Souza has more details.
Blaming a strong euro for France's limp recovery. In his first address to Parliament since becoming Prime Minister, Manuel Valls outlined plans to cut labour costs and reduce taxes. He's also pledged to shave 50 billion euros of the country's budget by 2017. Efforts he says will be in vain if the European Central Bank doesn't start to act outside the box.
The European Central Bank pursues a monetary policy that's less expansionist than its counterparts in the US, UK and Japan, and it's in the Eurozone where the recovery is less vigorous.
The Prime Minister is referring to the bond-buying programs undertaken by central banks in America, England and Japan. The IMF's World Economic Outlook released Tuesday offers the same suggestion to the ECB. It says more monetary easing is necessary to sustain activity and lower the risk of deflation. At the ECB's policy meeting last week, Mario Draghi said the bank was ready to act if needed, but he said it's governments within the Eurozone who need to be doing more.
Further, decisive steps are needed to reform product and labour markets with a view to improving competitiveness, raising potential growth, generating employment opportunities, and making euro area economies more flexible.
It remains to be seen if France can find other partners within the EU in the fight it's picked with Europe's central bank.
Okay, I don't have a lot of time left, but let's talk you through the stock markets before I leave you. Over in the United States, we've seen indices snapping a 3-day losing streak. We've seen the Dow Jones come off its previous highs, though, and it's currently in negative territory. The Nasdaq and the S&P 500 are still in positive territory. Now, there was red across the board when the main stock markets in Europe closed earlier. The Paris CAC 40 down 0.25%, with the Ukraine crisis putting a dampener on shares. We've also got time for one corporate story. Now, a US court has ordered the Japanese drug company Takeda to pay $6 billion in punitive damages. That's 6 times more than Takeda's last full-year profits. The ruling is part of a legal fight over claims that the firm tried to cover up a possible link between its diabetes drug Actis and bladder cancer. Takeda's American business partner Eli Lilly was also ordered to pay another $3 billion. The two companies say that they'll vigorously challenge this decision. Okay, that is the business news for now, and it's back to you, Laura.
Thanks very much, Marcus. We've got all the juicy bits from the internet now. It's time for our daily dose of web news.